Everyone always has a certain level of fear with anything in life, and while this video is going to pertain more to investing, the concept applies to literally everything. Everyone always says not to put all your eggs in one basket or diversify or whatever other else they feel like spouting. Now, I understand that this is a completely normal idea, and it makes perfect sense because if you rely too much on one thing and then it doesn't work out, you're screwed. Supposedly. Well, while everyone else is saying this, you know what Kobe said? You can always find a way to make more eggs. We see this in every walk of life. In sports, the first people that come to my mind are Kobe Bryant and David Goggins. In the investing world, it can be Keith Gill, the GameStop guy, if you're unfamiliar. You have to be concentrated to get to where you want to be, whether it's being concentrated on one sport or having a concentrated stock portfolio. All this to say, you want to get rich? Take risks. That's literally all you need to know. The problem is, everyone already knows that, but no one wants to actually do it or knows how. Well, what you don't do is take stupid risks that you don't understand. You have to take calculated risks. BizPath even says the same thing. If you don't know who he is, he's another finance Call of Duty YouTuber, and he's like 26 and he's a millionaire. So take it from him. I remember a video of his where he said he wishes he would have taken more calculated risk when he was younger because at this point, he could have been 10 times where he's at today. So, to circle all the way back to the investing world, I'm not trying to contradict myself. I do believe most people would benefit from a classic boglehead approach to investing where they put money into the S&P 500 on a consistent basis. But I do want to say that you can make much more than the average S&P returns if you just don't be a wuss. Stop being scared of taking risk and take some time to learn a bit more about investing so you're not going in blind. At the very least, you could put money into the QQQ. That's been outperforming the S&P over the past 20 to 30 years at least, and it's practically the same thing. But as I've come to find out since I've gotten more and more knowledgeable about investing, it is possible to beat the market, and it's actually not the hardest thing in the world to do. Let's look at some of the top stocks in the S&P 500, the ones that move the index the most. Nvidia up 25% year to date. Microsoft up 21% year to date. Google up 12% year to date. The list goes on. VOO is only up 10% year to date, and QQQ is up 11.7. It's supposedly impossible to beat the market, but there's numerous stocks doing so right now. Obviously, there is some cherry picking going on, and there are some stocks like Amazon that are only up 3% year to date. But again, there's a lot more that are also still massively outperforming that I didn't mention, like Broadcom. Take a look into that. Now, again, not to contradict myself, but I think the healthiest way to go about this is to have a certain level of balance. Of course, if you want to get to the absolute top, you can go all in and hold nothing back. But for the majority of people who just want to be decent investors and get a few percentage points above the benchmark index every year, here's what you should do. If you're really scared or not in a good place to start investing, this is going to sound tedious and it's going to sound like I'm regurgitating a bunch of information that everyone says, but it's because it's actually a necessity and it actually works. Set up a high yield savings account with either a small emergency fund or a few months' expenses if you really want. It'll calm you down a bit, but it's really not a necessity right now. You can have some stocks that lose a large amount, but if you ever lose your entire portfolio to the point where you actually need an emergency fund, you're doing something wrong. The next step is to figure out an investing style that works with you. From my experience, and this is going to sound like a little bit of propaganda, but I like dividend growth. I honestly, from the bottom of my heart, believe that dividend growth investing is the easiest route to go for a beginner investor. Not only does a growing dividend signal that a company is confident, obviously not 100% sure, but confident that they can keep that up, and who knows a company better than the actual company itself, but also dividends are the most surefire thing in the entire realm of investing. Again, not 100%, nothing in investing is, but if a company can easily afford its dividend payment and has been doing so for a while, you can pretty much damn near expect some type of money to continue coming in regardless of your share price. Now that I have dividend growth in mind, I have something that I can focus on and stick to. And a quick tip, think about the companies that I gave earlier. Each of those were very well-known companies, and they were all some of the biggest in the S&P. You don't need to find some random penny stock that develops Xbox controller grips that's supposed to be the next GameStop. That, in my opinion, is the easiest way to lose money. Don't be afraid to buy well-known companies simply because they're well-known. You're not going to miss the bull run. In a lot of cases, that's actually even more of a reason to buy. Just because Microsoft stock rose almost 65% from its October 2022 low by July 2023 doesn't mean it can't continue up. Microsoft is a great company, and since then it's gone up another 45%. The stock market is designed to continue upward over time. It can have some pullbacks and even some crashes here and there. Peter Lynch actually gave the example of over the last 93 years from when he spoke. The market has had 50 declines of 10% or more, which means that about once every 2 years, the market falls at least 10%. And in the same vein, once every 6 years, the market averages a 25% decline. All of this to say, at some point, the market will go down. That's fine. It's a part of the game, and you shouldn't be fearful. If you understand and in turn are confident in the companies you're invested in, you will be fine and you'll have so much peace of mind. The biggest piece of advice that I can give when it comes to markets or individual stocks crashing is that it's just on sale. If it's fundamentally the same stock, then you literally have nothing to worry about. And if you are worrying, maybe you should reevaluate some things a bit. But during that tariff crash, my total account went in the red by almost $1,500. But I kept buying. I was like a kid in a candy store seeing everything on sale. This stock was 30% off. This stock was half off. And that was just a few months ago. Now my account has a total profit of over $3,000. Not only did I come up from that negative $1,500 slump, but I actually tripled that to come all the way up to my all-time high in my account. I'm currently outperforming the market year to date, and I'm still an amateur investor. It is possible. Not just from my experience, but other people as well. I know Joseph Carlson has been outperforming the market for years, and while I don't know much about the state of other YouTubers that I watch, like Dividendology, I'm sure they're outperforming too. Dividend growth isn't the only way to go. There's several other styles of investing. It's just what I found I really liked. If you're curious about it and you want to see more videos, I got a bunch on my channel, and I'll put a link to a video on screen at the end. If you don't like my voice, Dividendology is another great channel. Dividend Talks is also a really good channel. He makes things very easy to understand. I just wanted to get this video out here to say, don't be afraid. Take calculated risks. Take as much calculated risk as you can. I've been trying to take more in my life as well, especially since I'm younger. I try to take as much calculated risk as I can. But at this point, I'm repeating myself over and over. So all that to say, if you enjoyed this video, consider leaving a comment. Consider subscribing. I'd really appreciate it. Good luck on your investing journey.